Hey, welcome or welcome back. Since Google is one of the biggest positions in my portfolio and they reported earnings last week, I thought it was a good idea to look at this one again, do a valuation, and let you know what I'm doing with my shares. I'm not going to spend too much time on the earnings themselves. There's so many videos out there that cover the earnings, and you've probably watched some of them already. If you're watching this video, you probably already have looked into the earnings. I want to really get into the valuation and what I'm doing with my shares. But just a couple of highlights before I do that. They did have really good revenue growth, 24% year over year. Google Cloud acceleration was really strong. But then on the negative side, everybody's been talking about the CapEx and the negative free cash flow. Those are really some of the big talking points that came out of these earnings. So, what I did for Google stock was I actually broke this down into the different business segments and I looked at what I thought growth and margins would be for each segment over the next 5 years going forward into the future. So I looked at the revenue for the last 12 months for each business segment here. And then I went years 1, 2, 3, 4, and 5 years out. I estimated a growth rate for each year, which you can see here. So, for example, for Google search and other, for the first year, I have 15% growth in revenue, and then 13.5, 12, 10.5, and 9. For YouTube ads, I assumed 11%, 10, 9, 8, and 7. For Google Network, I forecasted continued decline like they've seen recently. For Google Cloud, I estimated 50%, 40%, 32%, 25%, and 20%. Other bets, I'm factoring in some acceleration in revenue growth here, partially or largely because I think that Waymo will grow revenue and they're going to continue to grow that part of the business. So I did factor in a pretty good amount of growth there, but as you'll see, I do think the other bets part of the business, that doesn't mean it's going to be profitable. So we'll look at that in a minute as well. Hedging gains, I left that at 0. And so you can see the total revenue growth for each of these years going forward. So going 1 year out from now, forecasting just under 20%, and then about 18%, about 16%, about 14%, and then 12%. And then once I have that revenue number 5 years out, what I did was I assumed an operating margin for each business segment. So for Google search and other, for example, I forecasted a 43% operating margin 5 years out. And then, like for YouTube ads, I forecasted a 30% margin. And then Google Network, I said a 15% margin. Google subscriptions, platforms, and devices, I went with 25%. For cloud, I actually factored in some decline in their margin 5 years out and said, what if it goes to 25%? Now, I also have a scenario that we'll look at where I did boost that up to 35%. And it's hard to say what's going to happen with cloud margins because there's so much demand for it right now. I'm afraid to factor in too high of margins for cloud with the idea that once this build out is more along the way and it's a more mature thing, not just for Google, but across different businesses, that it might be more difficult to maintain higher margins. But it's also possible that, they have leverage as this gets built out and that they can have higher margins. So I have a scenario here where the operating margin that I assumed was 35%, and I'll show you that at the end as well. And then for other bets, I'm actually assuming negative 100%. This is assuming growth in Waymo revenue, but that the segment continues to lose money due to the costs of growing Waymo along with other projects. And then I have less alphabet level activities. So this assumes that this number grows along with the business at a rate similar or the same to what it was in that Q2 earnings report. So what this is the alphabet level activities. That is costs that aren't necessarily for one particular segment. in the accounting, but they're at the Alphabet level, so the overall company level and their expenses in that regard. So as it said here in this last earnings report from last week, Alphabet level activities primarily reflect expenses related to our shared AI research and development. This is a key number because if these expenses do decline, or they don't grow, you know, at the same rate as the business in this example, that could lead to more profitability. But I'm assuming that it's going to grow along with the business at the same or a similar rate. So that allows me to get a total operating income number, and you can see the total operating income margin here at about 28%, which would be a decline from the current number in this scenario. So just bearing that in mind, this is, I think, a conservative valuation. And then looking at an income tax rate, estimating 20%, could be a little higher or lower than that. For net interest and other income, I'm assuming 0, which if they remain free cash flow negative here for this next couple years, maybe they do have to pay some interest expense. So, we'll see. As of now, I thought it was still okay to leave that at net 0, but that is another factor that could be a moving piece here. That allows us to get a net income number, a margin here, you can see. And then I went with the number of shares used in that Q2 earnings release. So this is the number of shares used in diluted net income per common share calculation. So this basically assumes that future dilution is offset, but the share count's not reduced. So it's assuming they're not going to do buybacks to the level of reducing the share count, but that they're not going to, it's assuming that they will offset dilution, though, eventually over the next 5 years. So that's the number I went with there. And that allows us to get a trailing 12 months EPS after year 5 of $17.09. So if we then go and look at what that means for potential proceeds at different multiples, if we take that $17.09, we multiply that by different multiples here, we can get a stock price. You can get some estimated dividends, which I factored in some dividend growth here of about 5% per year, I think is what I did here. And so we can get some total proceeds. And that, based on the current Google stock price, had 326.56. This is actually using Google Finance formula here in the spreadsheet, and that's the number it's giving me. We can see the upside, and then also a CAGR over the next 5 years. So if this scenario played out, my base case would probably be around this 22.5 times multiple. Although you could make the argument maybe it trades higher. Someone could also make the argument that it trades lower in 5 years, depending. But if I go with this 22.5 times multiple as my base case, we're looking at only about a 3.58% CAGR here over the next 5 years. So under this scenario, a lot of Google's growth over the next 5 years would be priced in. Now, if you think it's going to trade at 27.5, you're starting to get towards, so you get a 7.78% CAGR here. So that's a better return. But that's if it trades at that higher multiple. Obviously, there's other things that could be moving factors here, like margins being better, growth, having more growth. One of those other bets businesses, growing a lot faster. So there are things there to consider, but, being a little conservative and trying to come up with what this might look like, I think a lot of growth here is already priced into the stock. Now let's take a look at if the future margins in cloud are 35%. You can see how, this does improve things a little bit. That gets the trailing 12 months earnings per share after year 5 up to $19.19, which, that therein shows if you had that 22.5 times multiple after year 5, You're looking at a CAGR of about almost 6%, 5.98%, which is better than the 3.58%. So if you think that cloud can have a higher margin into the future, you would expect higher returns. This is just a couple different models to give us an idea of what things look like. Now, all that said, this is still one of my more core positions in my stock portfolio. And so the question is, what am I doing with this if I think that a lot of growth is already priced in and maybe there's not as much upside to this as there used to be? Am I selling the stock? Now to really understand where I am at with my Google shares, you kind of have to understand uh, my journey with this along the way. So the first time I bought Google stock was December 5th, 2024. You can see I marked here on the daily chart that candle. And then I stopped buying Google stock April 28th, 2025. So I was buying the stock within this window in here. And this was around the time where people thought that Google might get disrupted, that OpenAI and artificial intelligence was going to really hurt the revenue of, um, or at least it was going to hurt Google search in general. And I then sold some shares February 3rd and 4th. And you can see I marked these arrows. I think I did a prior video where I showed how at this time there was bearish divergence here on the chart. And I actually almost sold this local top. So I did really well on this, selling some shares on February 3rd. And then I only drew this to one candle, but this first candle here is the 3rd. And then the 4th was the following day. So I was selling Google stock in these 2 days. So I kept what I for now anyway am happy with as a long-term position in my accounts. And so as of now, I'm not planning on selling anymore, even though, as you can see, after I sold, it did trade down. It had a nice run up again, and now it's trading down again. We're up around the 200-day moving average here. I do, even though this is, I think a lot is already priced into the valuation as I showed here. I do still think that this is a company that I want to own, and that could be a long-term compounder and play a big role in AI in the future. And so I don't really want to um, sell any more of what I have at this time. Right now, I'm still viewing this as a long-term part of my portfolio. But I will be honest, after looking at this valuation and doing this valuation, it has made me think about it a little bit more. So, especially maybe in some of my tax advantaged accounts, depending on how things go, I might decide to take some more profits, but as of now, I'm not planning on it. I'm planning on just holding on to my shares. Um, so, if you missed my recent video about Dexcom stock, which is another stock I've been buying, make sure you check that out. And if you found this video helpful or informative at all, please click the like button, subscribe, click the bell to get notifications. Follow me on X at Stock Sale Flyer and PayPal earnings tomorrow. So I'll be planning on doing a video after that to also update you on that. I have not given up on PayPal stock. So I'm looking forward to that earnings report tomorrow, and we'll see how that goes. Thank you so much again. Take care. Bye.